China's collapse has started, and it will take the U.S. down with it. I'm your host, Steven Van Metre, and thanks for joining me today as the situation in China is getting much worse and threatening to collapse the global economy and the U.S. equity market. Now, I want you to understand that today's show, we're going to look at what's going on in China, but I don't want to suggest that China's problems are going to transmit here. What I want to suggest is that when the world's largest exporter is having problems for their own reasons, that eventually translates to the world's largest importer, the United States. And when China's stock market starts to crash, well, it means the U.S. stock market isn't far behind. Let's head over to the Wall Street Journal where we picked this story up. The Chinese markets tank, and this is a headline that we're going to see, these first three words, coming to the U.S. before long, as investors worry about COVID-19 lockdowns. Two widely watched Chinese stock indices roughly fell 5% as the yuan hit its weakest level since November 2020. And the Chinese stocks suffered their worst sell-off in more than 2 years, and yuan hit its lowest level since the late 2020 as investors worried that strict policies to combat COVID-19 would add to pressures weighing on China's economic growth and corporate profits. Now, this is something, those last words, economic growth and corporate profits, when we look at what the Fed is doing and is about to do next month with tightening monetary policy, what are they trying to do? They're trying to pull back the reins of economic growth, and that will have a direct impact on corporate profits. The battle with Omicron variant of COVID-19 is adding to a series of challenges for China's economy and markets on top of domestic regulatory crackdowns. The war in Ukraine and a shift toward tighter monetary policy, again, key words, tighter monetary policy coming to the U.S. by many central banks to tackle galloping inflation. And economists have slashed their forecast for Chinese expansion, with the International Monetary Fund last week cutting its 2022 growth forecast for the country to 4.4%. Now, in the U.S., 4.4% is a big number. In China, not so much. That is a big decline. And banks downgrading their predictions. Foreign investors have pulled billions of dollars from the Chinese stock and bond markets, which we're going to talk more about in a little bit. On Monday, the Shanghai Composite and CSI 300 indices fell 5.1% and 4.9% respectively. Those were the largest single-day percentage declines for both benchmarks since February 2020, when anxiety over the fast-spreading coronavirus in the early days of the pandemic led to a sharp falls in Chinese markets after the Lunar New Year holiday. So what you're seeing is in the China's economy is the stock market is reacting to these lockdowns. Now, I don't want to suggest lockdowns are coming to the U.S. because I don't believe that's the case. What I want you to understand is that when problems happen in the world's largest exporter, they do directly transmit with a lag to the world's largest importer. But let's continue with this China story because I want you to see the big picture here. As the offshore yuan fell steeply as the dollar rallied, weakening past 6.6 against the dollar, according to FactSet. The decline built on a sell-off last week that ended months of relative stability. Shortly after the currency crossed 6.6 per dollar, China's central bank said it would tweak its foreign exchange policy, helping the yuan pare some of its earlier losses. So what's happening here, and this is going on with all central banks, is when you have your currency pegged to the U.S., the Fed is your de facto central bank. Now, you have a central bank, but really whatever the Fed's doing, you're going to do. So when the Fed tightens, then you have to tighten as a result. And if you don't tighten, then you see your currency depreciate and you experience higher inflation as a result of that. Now, what does nobody want right now? Higher inflation. So you might have noticed that some central banks have started front-running the Fed. They knew the Fed was going to tighten, so they started raising policy rates. And other countries like Japan, which we need to do a show on pretty soon, have gone the other route and will likely experience high inflation. So with China, what you're seeing them do right now is saying, wait a minute, we need to put a halt to this. But in here in a little bit, I'm going to show you that they're still trying to ease because of all these problems they're having due to shutting down their economy, and it doesn't work. Let's continue on. Because China was already confronting weak consumer demand, and the lockdowns have exacerbated that weakness, helping explain the stock sell-off. Part of the stress on Chinese markets comes from foreigners scaling back their positions. Last month, international investors cut their holdings of Chinese bonds by a record $15 billion and sold a net total of about $7.1 billion of Chinese stocks. So where is all that money going? It's coming to the U.S. And so what happens is when problems start with the exporting nations, so around Asia, but we'll focus on China with today's show, when things happen and go wrong there, investors pull their money out and they go to what is perceived as a safe haven, which is U.S. equities. And the reason they do that is because U.S. equities generally are not responding to the fact that there's weakness in Asia. And it makes sense if you think about it. If you have problems from an export perspective, well, there's a lag between the time that all that stuff gets to countries like the U.S. who are importing it. And that's why you see a lag. So the flight to safety becomes U.S. equities, and inevitably, that's why U.S. stocks are the last domino to fall. If you've ever wondered, this is why that happens. And we're going to look at that a little bit deeper. Let's continue on, because still, the People's Bank of China probably wouldn't allow a large near-term depreciation of the currency because they can't. It would cause more inflation, pointing to its recent record of setting a midpoint for onshore yuan trading that was stronger than implied by market prices. Late Monday, the PBOC said it would require financial firms to hold smaller amounts of foreign currency in reserve. The offshore yuan regained some ground to trade about 6.586 per dollar, a level that's still put on course for its weakest settle since November 2020. So what China's trying to do is get its currency to appreciate, but at the same time, it still needs to ease because it's in lockdown, and at some point it's going to come out of lockdown. And remember what happened in the U.S.? We had a lot of fiscal stimulus and monetary stimulus. Well, they're going to need a lot of help too, but the problem they're facing is, will their economy crash before they get out of it? All right, let's see what they're doing with the banks, because now you can see what's going on with the easing. As this headline, several major Chinese banks to cut deposit rates, as some of China's biggest banks are lowering the interest they offer on deposits, as authorities have encouraged lenders to do so to ease their cost burden among the ongoing COVID-19 pandemic. Several Beijing branches of major banks have released notices they will reduce the upper limit of the interest rates on 2- and 3-year fixed deposits by around 10 basis points on Monday. And so what are they trying to do here? They're trying to get money out of the banking system and moving through the economy to keep the economy going, because when people panic, what do? They take their money and they lock it down in the bank because they're concerned about the future. Well, there's some other things going on, and I want you to just see how bad things are. Now, we've seen kind of from the bigger picture, but let's go to the ground level and see how actual Chinese people are dealing with these lockdowns so you can understand just how bad it is there. This headline from Bloomberg is China's spreading outbreak stokes fear of Beijing lockdown. Worries that the country restricted adherence to COVID-0 will further damage the economy, drag down on stocks to oil and iron ore on Monday. It's also sparked about a panic buying. Remember that happened here in the U.S. as Beijing residents, fearful of being caught unprepared in the event of a citywide shutdown, rushed to stock up on food and other supplies after the government announced mass testing plans and put some areas under lockdown. The city of more than 20 million people in the country's political center locked down parts of the Eastern District, although supermarkets remain open with plans to ease restrictions after residents complete a testing regimen starting on April 27. Officials have warned more cases in coming days, with Beijing city government worried about the outbreak is complex and stealthy, while vowing to take further measures. So again, you see, they're just shutting down the economy. We know what this means domestically. It's bad news, and that's going to transmit to the rest of the world, because when they're locked down, well, they're not producing the goods and service goods to export and moving those goods to the rest of the world like they used to. And that's a problem for the rest of us. As China repeatedly defended COVID-0, saying the policy saves lives and keeps the economy going, although I'm not sure about the second part, even as the strategy increasingly darkens the country's growth outlook and threatens to disrupt global supply chains. And so you start thinking this from a profit perspective, and what happens is if U.S. suppliers can't get the parts they need to complete things, so say you're waiting on a chip to finish building a truck to sell it, well, if you can't get those chips, you can't sell the truck, and then eventually that impacts U.S. corporate profits, but with a lag. So let's get a little further into this, and then I want to show you why this is so bad for the U.S. stock market, as long lines are already snaking around apartment complexes, residents wait for tests. Online brick and mortar grocery stores have sold out of fresh food, kitchen staples, and other basic mass and antiseptic. Officials said on Monday afternoon briefing that some stores are stocking up supplies to 3 times the sale volume in normal times to accommodate surging demand. So when they do come out of lockdown, well, you know they're going to want their consumption first before they worry about the rest of the world. But now this will blow your mind. Wait till I show you what happened to the Chinese stock market and how it relates to the U.S. market. Again, I want you to think world's largest exporter, world's largest importer. So the exporter China is in purple. This is the ETF symbol FXI. And here you can see when it's rising against the S&P 500, that will note that they tend to move together. But notice here where the FXI peaked and it started to come down, the U.S. equity market had a bit of a problem and then went rallying because, hey, everything was okay. And all of a sudden the reality set in, hey, there's problems around the rest of the world, and boom, there comes the market down. And here again, China stocks rallied, U.S. stocks rallied, but notice that China stocks kind of peaked out here, and the U.S. equity market, hey, everything's fine, everything's great, no worries, no worries. Chinese stocks crash, U.S. equities follow down. Now look what's happened. You have this big peak in Chinese equities, and it's gone down, 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 down. And what do people here believe? That we are at the early stages of the next U.S. bull market. But Chinese equities don't suggest that at all. In fact, they suggest that U.S. equities are soon to come crashing down. But one of the reasons U.S. investors never see that is because some of the good news out there, such as today, well, it masks their ability to understand. And the Chicago Fed National Activity Index pointed to a slight decrease in economic growth, but still big numbers as the index moved down to plus 0.44 in March from plus 0.54 in February. Keep in mind the baseline is zero. So if you have at trend growth, it's at zero. So this is well above trend growth as we see the index move higher. But what we are noticing about the index, see here in December 2021, we had at trend growth. After big moves that decelerated, you see October, November, it slowed down and then dropped to trend growth and then popped back in January, slowing in February, slowing in March. So all we're seeing is now a continuation that the U.S. economy is decelerating, but it doesn't compare to the rest of the world with a lag. So just keep in mind what happens in China eventually happens here. Doesn't have to be for the same reason. Doesn't mean we're going to the lockdowns or anything like that. It just means when problems happen there, as you can see in the equity markets, they eventually come here. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.